Small cap stocks just posted their best first half since 1991. Not their best month, their best 6 months in 35 years. And the majority of everyday investors either missed it entirely or they are now asking one very dangerous question. Is it too late to get in? That question matters more than most people realize, because the answer is not what financial headlines are telling you, and getting it wrong could cost you a significant amount of money. Let me explain what actually happened here. The Russell 2000 is the index that tracks small cap stocks in America. These are companies with market values typically between $300 million and $2 billion. Not the giants, not Apple or Nvidia, the smaller, more domestic, more economically sensitive businesses. And in the first half of 2026, they quietly outperformed almost everything. According to Barron's, small caps just delivered their best first half since 1991. That is not a minor detail buried in a footnote. That is one of the most significant market performance milestones of the decade. But the financial media spent this week talking about the Dow crossing 53,000, and Nvidia and chip stocks bouncing back. Small caps got maybe one paragraph. Hold that thought, because it becomes important later. First, let me give you the context for what is driving this. Three things are happening simultaneously in this market, and when all three align historically, smaller companies benefit disproportionately. The first is falling oil prices. WTI crude has fallen back near pre-Iran war levels after a sharp spike earlier this year. That matters for small cap companies in a very specific way. Smaller businesses operate on tighter margins than mega corporations. Energy costs hit them harder as a percentage of total expenses. When oil falls, their cost structure improves faster than it does for large companies. Their profits expand more quickly, their earnings surprise more dramatically, and Wall Street reprices them upward. That is not theory. It is the mechanical relationship between energy costs and smaller business profitability. The second driver is jobs. U.S. monthly job gains have averaged 92,000 so far in 2026. That is dramatically better than the 2025 average of just 9,700. Small cap companies are disproportionately domestic. They sell to American consumers. They hire American workers. When employment is strong, their revenue base expands directly. They are not protected by global diversification the way large multinationals are, but they also benefit more purely from domestic economic strength. Right now, that domestic economy is holding up better than most expected. The third driver is the broadening of the stock market rally itself. Charles Schwab's research team noted something important this week. Outside of the AI trade showing some fatigue, the broader market rally is still intact. Economic data remains strong. Growth forecasts have not deteriorated. Second quarter S&P 500 earnings growth is projected at 23.3% year over year. When the rally broadens beyond a handful of mega-cap tech stocks, smaller companies benefit. Capital rotates. Money that was concentrated in Nvidia and Microsoft finds new homes, and small caps are often the first destination. Now here is where the 1991 comparison gets genuinely interesting, and also potentially misleading. In 1991, small caps surged coming out of a recession triggered by the Gulf War. Oil prices spiked, then collapsed. Interest rates fell sharply, and small cap companies roared back as the domestic economy recovered. The surface level pattern looks similar to today. Oil spike, geopolitical tension, resolution, falling energy prices, market broadening. But the underlying conditions are fundamentally different. In 1991, the Fed was cutting rates aggressively. Today, the Fed under Kevin Warsh has been signaling potential rate hikes, not cuts. In 1991, U.S. debt levels were relatively contained. Today, they are not. In 1991, the AI spending cycle did not exist. Today, it is absorbing enormous amounts of institutional capital that might otherwise flow into smaller stocks. If you financial strategies simply by copying what worked in 1991, you would be making a structural error. The environment rhymes. It does not repeat. If you enjoy breaking down markets and money, subscribe for future updates. So what does this mean practically? Let me give you 3 specific things to think about. The first is exposure, not concentration. Small caps outperforming does not mean you should move your entire portfolio into the Russell 2000. It means that if you have zero or near zero small cap exposure, this moment suggests revisiting that. Most target date retirement funds and simple index funds are heavily weighted toward large cap stocks. That has worked for years. But a market environment where oil is falling, employment is strong, and the rally is broadening is one of the few environments where that large cap tilt becomes a drag, not a catastrophe, a drag. A small cap ETF or a mid cap blend can be a straightforward, low cost way to adjust that balance. No individual stock picking required. No guessing which small company wins. Just expanding your exposure to the broader economic recovery story. The second thing to consider is the difference between momentum and value. Small caps have already had a historic first half. The risk of chasing performance at this point is real. The most disciplined approach is not to pile in at the peak of enthusiasm. It is to establish or expand a position systematically over the coming weeks. Smaller, regular investments spread over time reduce the risk of buying at exactly the wrong moment. That approach is not exciting, but it is how long-term wealth actually gets built. The third consideration involves the sectors within small caps. Not all small cap stocks benefit equally from falling oil and strong employment. Small cap industrials benefit directly from infrastructure spending and domestic manufacturing. Small cap consumer discretionary companies benefit when employment is strong and gas prices fall. Small cap financial companies benefit when the domestic lending environment improves. Communication services and energy-related small caps are more complicated in this environment. The point is that small cap is not a monolith. Understanding what is inside the category matters as much as the category itself. Now step back for a moment. This is not a story about a short-term trade. Morgan Stanley's mid-year outlook described the current environment as an uneasy boom. AI investment is driving growth. Energy supply uncertainty from the Iran conflict is creating turbulence. But the cycle has not run out of road. That phrase is important. The cycle has not run out of road. For small cap investors, that framing is meaningful. These are not companies that thrive in a recessionary environment. They thrive when the economic cycle is extending, when growth broadens, when consumer confidence holds. Right now, despite the noise, the data is supporting that picture. Job creation is recovering, oil prices are moderating, earnings growth projections are strong, and institutional investors rotating out of concentrated AI positions need somewhere to deploy capital. That combination does not guarantee small cap outperformance will continue. Nothing guarantees anything in markets, but it does create a rational data-supported case for increasing exposure. One final thought. The people who will benefit most from this small cap moment are not the ones trying to time the perfect entry. They are the ones who recognize a structural shift, understand why it is happening, and build a position with discipline. The best first half since 1991 already happened, but the economic conditions that drove it are still in place today. What you do with that information is completely up to you.